Hello everyone and welcome to my channel. Today we continue learning purchase discounts from the purchaser's perspective. As we learned in part 1, when accounting for purchase discounts, there are two methods to choose from, the gross method and the net method. Today we will look at recording journal entries under the gross method. If you haven't had a chance to watch part 1, I'm posting the link here and in the description below. This slide shows a side-by-side comparison of how transactions are recorded under the gross and net methods. Note that both sides are for periodic inventory system. Under the perpetual inventory system, purchase discounts are credited to inventory rather than to a separate expense account. Let's look at the gross method. When a company uses the gross method under the periodic inventory system, it records the purchases and accounts payable at the invoice price, which is the gross amount. The gross method is more straightforward and therefore it is more popular. The first journal entry is to record a purchase of bicycle inventory with the cost of $10,000, terms to 10 net 30. Since the gross method is used, both debit and credit are for $10,000. The purchases account is increased or debited, and accounts payable is increased or credited. Just a reminder, assets and expenses are increased by debit and decreased by credit. Liabilities, on the contrary, are increased by credit and decreased by debit. If you need to review the rules of debit and credit, I'm posting the link to the video here and in the description below. The second journal entry is to record a payment for invoices of $4,000, which were paid within the discount period. A purchase discount is recorded if the company pays within the discount period. When determining the cost of goods sold, a company records purchase discounts as a deduction from purchases. Therefore, purchase discounts is a contra account. It is increased by credit and decreased by debit. Let's briefly review what 210 net 30 means. 210 net 30 means that the buyer will receive a 2% discount on the net amount if they pay the invoice in full within the first 10 days of the invoice date. Otherwise, the full invoice amount is due in 30 days without a discount. The journal entry is recorded as follows. Accounts payable is decreased or debited for $4,000. The purchase discounts account is increased or credited in the amount of $80, which is 2% of $4,000. And cash is decreased or credited by $3,920. Note that accounts payable needs to be debited for the full amount of the invoices, as the buyer no longer owes anything for these invoices. If you are not very comfortable with the rules of debit and credit for liability accounts, start with cash. Cash is usually the easiest account to deal with. Once you have cash and discount recorded on the credit side, you can calculate the amount of debit for accounts payable, as debits must equal credits. The third entry is to record payment of invoices for $6,000, which were paid after the discount period. Accounts payable is decreased or debited in the amount of $6,000, and cash is decreased or credited in the same amount. Note that no discount is taken, as the invoice is paid after the discount period ended and no longer eligible for a discount. On this slide, you see a T account for accounts payable. Accounts payable is a liability account and its normal balance is credit. It is increased by credit and decreased by debit. First, it was increased or credited by $10,000, the amount of the invoices, and then decreased or debited by $4,000 and $6,000. The ending balance in the accounts payable account after all invoices are paid must be zero. That's all for today. I hope you found this video helpful. If you did, please subscribe, hit the like button and ring the notification bell so you're notified when we release more videos like this. Visit my channel for more videos on financial and intermediate accounting. Thank you all so much for watching, and I hope to see you all again in the next video.